Hello, welcome to the latest in our series of webinars from Oxford Science Business School. Today we have the latest in a series in support of our Oxford-Chicago Valuation program, which is a 5-day executive education program for investment managers and directors working in M&A. Hang on, let me do that. Yep. There we go. So the program runs at the end of April, and we're taking registrations for that now. On our webinar today, we have two speakers. The host will be Andreas Angelopoulous, who's the Program Director for the Oxford-Chicago Valuation Program, and our main presenter will be Blair Jacobson, who's a partner at Ares Management. A little bit of housekeeping. So we have over 200 people registered for the webinar today. So thank you very much for joining us. Because of that number, we keep all attendees on mute. We would like to get your questions. So if you have any questions as we go through, then please put those into the Q&A panel in front of you, and then we will address those at the end. The main presentation will go through for about 30 minutes, and then there'll be time for Q&A at the end. So please put questions into the Q&A, and with that, I'll hand over to Andreas to introduce himself.
Thanks, Steve. Hello to everyone. Tonight, we have the pleasure to have a discussion with Blair Jacobson, a partner and co-head of Ares Credit in Europe and Chicago alumnus. One of the most interesting topics this period, the rise of private debt. Valuations are going up, equity returns are going down. That means private debt is becoming a very interesting asset class, and it's growing up in the US and in Europe. This topic that we will discuss today is part of the Oxford-Chicago Valuation webinars. I will introduce you to Blair, that he will give us a 30-minute presentation describing the private credit. We will have some questions and some answers, and we will receive all your questions and we'll touch all the topics. And then at the end, I will present you the Oxford-Chicago Valuation Program outline and the topics that we're covering, with Blair having a 3-hour session during the Oxford-Chicago Valuation Program, presenting direct lending, private debt, direct lending, and a case, a real transaction. That means very quickly, as a lot of people that they're alumni or they know my background, I was used to run the private equity center in Oxford, and I founded the Oxford-Chicago Valuation Program in 2013. I'm a Chicago alumnus too. I'm running as a CIO a private equity program that's investing in primaries, in equity and credit funds, and is doing equity and credit co-invest the last 5 years. Before that, I worked in the private equity and in the leverage finance and the venture capital area. And before that, I was trained as an engineer. This is about me, and now I will pass you to Blair to introduce himself and to start the very interesting presentation today.
Thanks, Andreas. Just by way of introduction, again, I'm Blair Jacobson. I'm a partner at Ares Management, where I am responsible for our European credit businesses, roughly 30 billion of assets under management. I also sit on the firm's management committee. As Andreas mentioned earlier, I'm a proud University of Chicago Booth Business School alumnus. Before we get started, I will read a brief disclaimer. The information in this presentation represents my views as of today's date, February 3rd, 2020. The information is being provided for informational and educational purposes and is not meant as investment advice. Accordingly, the information should not be relied upon. Neither Ares nor its affiliates guarantee the accuracy or completeness of any statements in this presentation. This presentation contains forward-looking statements, and future results may differ materially from the past. In addition, past performance is not indicative of future results. This presentation is not an offer to sell or a solicitation of an offer to purchase any security or interest in any fund. And lastly, since this is an electronic presentation, we would request that no screenshots are taken. So with that, why don't we dive in? I think the place to start here you'll see on slide number 4 is really, why did Andreas ask me to speak about private debt today? And I think the answer to that is what we do here at Ares and what we base our business on is the credit business. We essentially are very large at providing the L in LBOs, for those of you who follow the private equity industry. And Ares in particular is a large global diversified alternatives manager. We manage about 144 billion of assets under management. We're 20 years old, and we're listed on the New York Stock Exchange. There's a lot of information and transparency available about our company and our businesses. But what should immediately jump off the page, as I alluded to before, is we have 106 billion in credit assets under management. That's all sub-investment grade corporate credit. So again, that's loans, bonds, and middle market lending. And again, middle market lending will also be a key feature of today's conversation. Now, if we drill down into our direct lending business, which is today's focus, we're incredibly proud of the business that we've built. You'll see here up top that we manage over 70 billion in AUM in the strategy. For those of you who recall the prior slide, you would recollect that that's roughly half of what Ares does as a firm. So again, it's something that the firm takes very seriously and has a lot of historical experience in. We actually think we're the largest non-bank middle market fund-based lender in the world, and also likely the most global. We're one of the few managers, having done this in the US since the early 2000s, in Europe since 2007, that has a cycle-tested track record in both geographies. In fact, we've done over 1,300 investments since inception. We have around 190 people doing this business around the world. So I hope that gives you a sense as to the capability set that we bring and the insights that we'll bring to you all today as we discuss the asset class. So today, we'll talk about the key drivers of our private debt asset class, and we'll look backwards as well as looking forwards. So first, a walk down memory lane. When I started out on Wall Street in the early 1990s, all anyone could talk about were the barbarians at the gate, the RJR Nabisco leverage buyout. It was the largest buyout of its day. It was the most levered deal investors had seen in the markets. And from a credit perspective, with over $16 billion of loans, it'd actually still be a pretty big deal today. But I think what this does is this will highlight to all of you how our markets have changed significantly. For example, if you look at the 4 banks in the middle of the slide that were the lead underwriters of the transaction, some of you may know that not all of them are around today. There's been significant consolidation in the banking industry. In fact, when you look at the 100 syndicate partners, we estimate that perhaps around half of those don't exist today. And when you look at some of those names on the page, what you don't see are names like Ares. You don't see fund-based lenders. You don't see CLOs. So obviously, a lot's been going on in the industry to get us where we are today. And if you look at where we are around 20 or so years later, we've seen an industry develop and structure such that it actually competes very effectively with the banking market. In some ways, and in some regions, has replaced the banking market. There's been a significant increase in liquidity in both equity and debt, reflecting the growth in both private equity and private credit, such that we're now at a point where firms like Ares have led and held most of billion-plus transactions. So, how did we get here and where are we going? Well, let's start with a quick definition of what direct lending is. Recall what I had said earlier. This is really the L in the LBO. These are loans made to companies where the lender retains a significant portion of the loan. Now, again, this is very different from the underwrite and distribute model that we talked about a little bit earlier. Now, this tends to focus more on middle-sized companies. In Europe, you'll see here roughly companies would call it 10 to 75 million of EBITDA. generally smaller than can issue effectively in the capital markets. And our capital is used, I would say, most of the time in change of control situations, but again, part of the time when companies' debt comes to term and needs refinancing, also when companies make acquisitions in buy and build situations. Now, the companies that we lend to that fit those characteristics tend to be owned by a private equity firm or what we call a sponsor. Sometimes they're not. Sometimes they are listed companies, or they might be owned by families or entrepreneurs. And the lender, like a company similar to Ares, again, we make these loans directly to the company. We do not buy them over a Bloomberg screen, which you would see in the liquid markets. They're not underwritten by a large investment bank. This is a person-to-person business where we sit across the table from companies, their management teams, owners, stakeholders, and advisors, and literally make the deal happen. And when we do that, there are lots of advantages. Again, we write the documentation ourselves, which we think generates very strong deal economics for ourselves and our investors, as well as strong downside protection. And again, these loans, they can take a number of different shapes and forms, but by and large, probably the largest part of the market are senior or first lien loans with full security positions. So that's what direct lending is. Now let's talk about the evolution of the market over time. How did we get to the point where I said earlier, people in our industry, in particular areas, have been able to do such large transactions? Well, to simplify it a little bit, there are kind of two major stages. In the first one, obviously the banks were the main lenders in the industry, and bank influence, however, began to shrink over time. So the second phase was sort of, how did that happen? It happened slightly differently in the US and Europe. In the US market, and we'll show some data on this in a little while, the US banks consolidated significantly in the 80s and 90s, and as a result kind of left smaller companies behind. And then when the downturn happened in the financial crisis, banks obviously found more pressure on their balance sheets and had to face increased regulation, which dramatically impacted the amount of these types of debts that they could hold on their balance sheet. All of this created a very, very nice runway for direct lenders to grow market share in this business. In Europe, the development had some similarities, but also some key differences. Europe was dominated by the banks really up until the financial crisis. There were some funds operating in the market in Europe, mostly on the subordinated side, but in the first lien business, again, really 100% bank dominated up until the crisis. Really wasn't that level of consolidation that you saw in the United States market. But as a result of the crisis, a similar effect. The number of banks shrank dramatically, and the increased regulation that the banks that made it through the crisis felt made it much less interesting and profitable for them to hold these bank loans on their books over time. Now, illustrating this a little bit further, we've seen banks continuing to retrench from the middle market really for quite some time. If you put some numbers against it, again, on the top left of the slide, the total number of banks decreased by almost half, both in the US and in Europe in a 20-year period. And what you see then, in particular in the leveraged loan markets where the data is quite robust, is a decrease in the bank's share. The bank's market share holding these loans over time, again, went down quite precipitously in the US, and a similar trend seen in Europe. And one interesting trend to pick up on is that while it's very expensive for banks to make these loans to companies directly, you'll see on the bottom right, what's actually a bit more interesting for them in terms of their own capital controls and their balance sheets is actually providing loans to portfolios managed by lenders like Ares. So what we've seen is actually they prefer to take exposure to these companies by partnering with groups like Ares, providing credit facilities to our lending vehicles rather than making the loans directly themselves. So another theme that's helped develop the private markets more broadly is one around a shift from the public markets. I would say primarily this slide illustrates that trend in relation to the equity side of the business, but as we'll discuss, that's had significant impact in a positive way on the debt side. It's no surprise, many of you may be aware, that being a public company isn't terribly easy. In particular, if you're a small company, you face incredibly high costs, meaningful disclosures that really suck up quite a bit of management's time. And as a result, we've seen the number of companies going public decline. There was an article in the newspaper in the London Times a week or two ago saying that UK IPOs were at a multi-year low. And again, there are lots of different companies to target, but when you look at the chart on the right side of the page, there are 35,000 private companies with revenues under $1 billion. Compare that to public companies of a similar revenue size. It's less than 2,000. So again, the sphere and the opportunity set for these companies is quite significant. We're also seeing a trend that many of you may be aware of, where venture capital-backed companies are waiting much longer time frames to go public. So again, a lot more interest in raising capital and growing their businesses through the private markets than the public markets. Now, a lot of this is being driven as well through capital raised in the private equity industry. It's growing quite significantly. It's a very attractive investment opportunity for institutional investors. And today, roughly $600 billion of uninvested private equity dry powder at this point in time. I'd say one interesting point is that, as many of you know, private equity obviously relies on debt in order to get invested. Therefore, this dry powder will require credit resources, sometimes on roughly a one-to-one basis. So we can ask a lot of questions, and we'll start to bridge into the direct lending conversation at this point around how much money's been raised in direct lending. And you'll see that's the dark blue bar on the bottom of the page. Again, it's a pretty small percentage of the private equity money that's been raised. Therefore, again, we think that supply-demand is in a probably much better balance than what sometimes gets reported. So thinking about the middle market, this is a very, very dynamic section of the economy. You'll see here, actually, if you were to plot U.S. middle market companies and European ones, they rank actually as some of the largest economies in the world. Just the revenue of those companies put together shows really how powerful and how staggering the size of these markets are. And again, these are markets that create significant revenue growth, significant job growth. And again, a lot of that growth requires financing in order to help companies achieve their objectives. So again, it shouldn't be a surprise that when you have a combination of significant interest in private companies, capital on the equity side to finance those private companies and their growth. Similarly, the middle market opportunity on the credit side is expanding significantly. On the left side, witness the European markets. Again, at Ares, we've been doing this since 2007, before it was really a market. But if you go back the past 6-7 years, you'd see that the number of deals every year is growing. It was 140 or so in 2013, and in 2018, 2019 timeframe, it was over 400, and that represents over $40 billion of deployment on an annual basis. Similarly, if you look at the growth trajectory of the U.S. direct lending market, it is nearly $1 trillion in market size, which again is pretty staggering. And I think if you look at where that's concentrated on the right side of the page, low-yielding senior loans and target senior loans on the bottom right side, so much of that is resident in the area that the banks used to address. So again, this really illustrates the development of the market opportunity for direct lenders. Now, all of this is well and good, but we need to fund our businesses in order to have our capital to be able to put to work and to lend. And I think the good news is that the direct lending and private credit asset classes is viewed as being quite attractive by underlying investors. Those investors would include pension plans, insurance companies, sovereign wealth funds, public investors, in particular in the BDC space in the United States. The illiquid asset class, which is private debt, again, is viewed as very stable. It provides persistent premium to liquid markets. We'll talk about this again in a little bit with some more data. But more importantly, is very, very low volatility. Again, these loans are private. They're not traded. They're often held by a single lender. They show low correlation to other markets. They're shorter in duration, and they're floating. So again, all of these and more, when you add the yield of these investments for investors, again, illustrate just how attractive this market is. And if you look on the right side, just drilling in on Europe, we sort of have a front row seat on how this market's been developing. And you'll see when you look at the light blue bar, 20 plus billion is raised roughly every year into European private credit and direct lending funds. Again, just illustrating the attractiveness of this asset class, which we think may persist in the future. One way that we think that is when you look at market studies on the bottom, for example. This was recently reported in one of the main industry publications, Private Debt Investor Magazine, when they asked, how much capital do you plan to allocate to the asset class in the future compared to the past? And 29% of the respondents said that they were planning to put more into direct lending in the future than they had in the past. And that was the highest that they had seen. So again, a lot in the future to come. Now, the market data for what we do is a bit scarce. So some of the best market data on the deal side is in the US, but we think it paints an appropriate picture. If you drill down on why this is attractive, remember, interest rates have been low for a very, very long time, really since, the global financial crisis, more than a decade ago. And what that's created is a significant hunger for yield on behalf of investors. So when they look at what middle market loans will pay them, you'll see here, over a very long time frame, middle market loans have paid a higher interest rate, a premium to the broadly syndicated loan space. And interestingly, when you look at the leverage risk that you're taking on these companies, sort of similar 10-year data, the leverage risk on a company-by-company basis is 3/4 of return leverage less over time. So I think there's a view that those factors help compensate investors for investing in businesses that are slightly smaller and loans that are slightly less liquid. Another point to make here, we get asked a lot about investor and lender protections over time. And one thing to point out here is on the covenant side. This is covered in the press now quite a lot. The prevalence of covenant-light activity in the broadly syndicated loan space for bigger companies is quite prevalent. You'll see here roughly 75% of the loans have been cov-light over the past 6-7 years, whereas again, under 15% of middle market loans don't have those covenant protections. So again, we think the protections available are quite robust. Now, remember, we are debt guys. We worry a lot about the downside. That's one reason why we care so much about these protections. But it seems like at this point in time, there's a lot on our minds. There's a lot of uncertainty out there in the world, and we think about these factors every day when we think about our investing. And actually, if I were to update this slide today, I'd probably talk a bit more about the coronavirus, for example. But it really goes through every category, whether it's macro, and again, even without the coronavirus, the Chinese economy has been slowing. That's kind of new for the world. The German economy, narrowly averted recession. It's growing slower than the French economy, which is an interesting fact here in Europe. We obviously have new heads of the central banks, which is a new thing, both Lagarde in Europe and Andrew Bailey here in the UK. So the question is how will they react and think about setting monetary policy in the future, thinking about how the macro is performing. So again, a lot going on there. I touched on regulation a little bit earlier as a driver in behaviors as it relates to private credit, but spend another moment on it. Essentially what happened post-financial crisis was the regulators required, in particular banks, to hold more capital against the loans that they were making. And essentially this reduced the return on equity of these loans for the bank, so it made it less attractive for them to hold. Now, regulators have continued to iterate on these rules. Again, Basel II turned into Basel III. They're talking about Basel IV, for example. And in the U.S., Dodd-Frank, the Volcker rule, have had serious impacts in the leveraged lending guidelines, which even sought to cap the amount of leverage that could be applied to a particular company, has had a meaningful impact. Politics, you probably don't need to spend too much time there. As you'll probably be aware, on Friday night at 11 o'clock, the UK actually Brexited finally. So again, UK has a lot of work to do this year to negotiate a trade deal. Obviously, international relations as well, seem quite fragile at the moment. So when you combine all of these factors, plus other exogenous factors listed at the bottom, certainly a lot on our minds. But all of this sort of feeds into how does Ares think about lending late in the economic cycle? And again, focusing here a little bit more from a European perspective, but just to give you a sense, we believe this is a fundamentally defensive asset class. So again, considering a lot of the macro issues on the prior slide, what we really care about most is selecting the absolute best companies we can find. And how do we do that? We have well over 50 people in Europe looking for loans. As I mentioned, we started this business in 2007, 13 years ago. In 2009, so 11 years ago, we grew out of just a London office to add an office in Paris, Frankfurt, and Stockholm. Actually, last year, we also added offices in Amsterdam and Madrid. So we really believe that being local, speaking the local languages, understanding the local cultures, the credit documentation, also the legal and court systems, is a real important factor and an advantage for us. As I said earlier, again, we are looking for the best companies that we can find to lend to. We look at nearly 1,000 opportunities and companies a year, and again, really focused on finding the absolute best companies we can focus on and find. And those are companies that have, I would say, a couple of characteristics. One, strong revenue growth rates. We try to look for companies that are growing at least 10+% per year. Attractive profit or EBITDA margins, again, averaging roughly 20 to 25%, a real indication of companies' financial health. And again, we look at companies in defensive sectors. If you remember one of the first slides that I put up, again, we tend to favor sectors with real secular organic growth. That would include sectors like telecommunications, software, healthcare, education. When we see more cyclical sectors pop up, whether it's oil and gas, consumer retail, building products, construction, we would certainly view those as being less attractive from a credit perspective. And again, our loans tend to be first lien. In other words, we are the first lender to the company. If the company experiences any issues, we are first in line to get our money back. And we do that by having strong financial tests that the companies must meet. Those are called covenants. And we lend at pretty attractive loan to value. Again, you hear about company valuations being quite high at the moment. Again, I think our view is that in the market, we see roughly 50%, of those purchase prices being in equity, 50% in debt, which again, leaves a lot of cushion underneath lenders' exposures to companies. We can also reprice our risk. So obviously, we price our loans at the right level when we go, that we think that when we go into those businesses, and we can reprice our risk if the companies underperform. So we have ratchets in place and covenants that help increase our interest rates in the event of any underperformance. And again, if there's real underperformance, that's when we have our financial covenants kick in. Another question we get quite a bit is around interest rate policy. I alluded to the fact that there are some new faces and names in the central banks. So if rates go up, we make a bit more. If rates go down, it tracks, floating LIBOR. We do have some floors, which essentially have a minimum base rate in our loans as well. But again, that helps provide some insulation around returns. Now, if the companies do hit a bump, one thing we do here at Ares in Europe, same in the US, by the way, is we have our own in-house restructuring and workout team. Having people on staff in that field, again, when companies do have issues or hit bumps, we think helps us potentially maximize our recoveries over time. So again, when you take that, plus the fact that we try to get some equity upside in our loans, we really believe that this asset class is quite durable over time, and again, also quite defensive. And again, the last thing I'll say about this is a really nice quote from Hamilton Lane. They do a market study every year, and in the one that came out last year, they did an analysis, and it's what we would call the "how bad can it get" analysis. And they looked at lots of different asset classes listed below, and essentially since 1995. So really about 25 years, they looked at each of those asset classes and said, hey, where is the absolute worst return period for 5 years in a row? And you can see for asset classes like venture capital, the worst 5 years were pretty difficult, minus 15.7% for those 5 years. However, when you look at private credit, all the way on the left, actually was a gain over that time frame, which again we think really illustrates the resilience of our asset class. Again, when times get tough. And in fact, the quote from Hamilton Lane is, "If a downturn occurs next year, private market portfolios will be in the best shape they've ever been in prior to a downturn." So with that, I will finish my prepared remarks and transition over to questions.
Okay, thanks, Blair. This is great. I would appreciate if you will start to email your questions. I will ask a few questions to Blair, and then we will take your questions. As you mentioned, Blair, valuations are very high. That means there is a lot of dry powder from the private equity funds. They raised a lot of money. They try to buy the same companies. They participate in auctions. Valuations are high. And these valuations are driven more from additional equity than debt. That means in 2008, we had 25% equity cushion. Now the equity cushion is around 50%. That means when the valuations are going up for the equity guys, their returns should be expected to be adjusted if you will not sell in the same high price. This period, how do you feel without the dislocation to have arrived yet, to be as an investor between levered credit and equity? Is the gap between the equity returns and the levered credit returns becoming smaller or not?
Yeah, I think when we talk to the market and sort of listen to what they have to say, we collect a lot of different feedback. Some of the people we talk to are investors in private equity. I think their general view is yes, prices are high, but at the same point in time, that really means that you have to select the right equity manager who can really build the value of the business over time. So equity still provides an attractive potential return, but managers frankly have to work pretty hard in order to make it. One of the attractions on the credit side is that our returns are contractual. What that means is that we make money really in two key ways. The first is we get upfront fees for the loans we write for the benefit of our investors. And second, we make our interest payments. Therefore, when we make a return, it's fairly contractual. And when you put those into a very, very diversified portfolio, of maybe 50 loans, or maybe some people even have roughly 100 loans, lots got to go wrong for the lender to lose money, in particular in the portfolio. We always have this quote where we say, for us to lose money in our loans, that means the equity literally gets wiped down to zero. So I think that the resilience of our asset class really resonates quite well, with investors, and some of the data in the presentation would, I think, illustrate that. The second piece of what you asked around leverage, some of you might not be aware, but the U.S. direct lending industry, in particular through the BDC space, which again are listed loan vehicles essentially that lend to middle market companies, those structures have been levered for a very, very long time, and by and large, performed quite well through the GFC. I think we've been doing the same thing in our strategy here in Europe since 2007, and I think that levered first lien senior secured loans, again in great companies with low loss rates, can create attractive returns for investors over time, although leverage does add incremental risk to the portfolio and can magnify
floating, correct?
Yeah, we certainly would not take interest rate risk there. Again, our interest rates float, as I mentioned before, in credit facilities. Rates would also float as well.
And there are two other advantages when you compare risk-adjusted returns between equity and credit. That credit, you have the quarterly distributions, as you mentioned, cash distributions that you don't have most of the times in the equity. And the second thing is that the credit investment period is shorter. You lock your money for a shorter period, correct?
Yeah, I think one of the key attractions, and I'll build on what I had said earlier around the asset classes. Again, investors broadly are starved for yield. Again, if you look at where sovereigns and corporates from the investment grade side are trading now, even the broadly syndicated loan market and high yield market, they're sort of low single digit type returns. So if you're a pension plan, if you're an insurance company that has liabilities you have to satisfy, yield's quite important. So again, the types of loans, the types of interest rates that we get, we distribute that cash to our investors literally every quarter. Compare that to a private equity fund, which is obviously longer dated and would really only be able to return capital to its investors if it has some kind of realization or refinancing event. I would say direct lending funds can distribute to their investors starting maybe 6 months after they start lending over time.
My second question is, direct lending is not only about first lien, second lien, or can be unitrans, that is the new trend, or about subordinated, PIK preferred. What's your view about returns and risk going in the different sub-asset classes of debt?
Sure. For those of you who are familiar with Ares, I think you'll know that one of our hallmarks is that we always like to have flexible capital funds. What this means is we have funds with a fairly broad investment mandate where we can address any part of a company's capital structure. Now, this provides advantages to the companies because they can call us early, literally on any debt opportunity they're looking for, and Ares will have a solution for that. And we also think it helps Ares and our investors because we can price each and every part of a capital structure and figure out what we believe is the best risk-adjusted return of any company. And I think what we found specifically is, again, over time, the banks have really deserted, as we mentioned, the first lien market. Therefore, the senior secured opportunity and the unitranche opportunity has been quite important for us. But similarly, on the subordinated side, there's probably a little bit less of a market for that business in Europe. But in the U.S., we see a very strong market, for subordinated loans to, again, very, very high quality businesses that we know quite well. And again, there's usually a lot of equity underneath those loans in addition.
And what's your views on direct lending, U.S. versus Europe?
Yep. Well, I think they're both great. I think that if you drill into the similarities of the market, I would say that the loans themselves look fairly comparable. Again, not much different. A lot of those loans and companies will share very, very similar characteristics. I think some of the differences in the market, and this goes a little bit back to the slides that I shared a little bit earlier. The U.S. market has been around longer. Again, off the backs of early bank consolidation that we saw in the late 1980s and 1990s. So the U.S. market is certainly larger and more mature than what we see here in Europe, where again the market has really been functioning in its current format since the global financial crisis. Another point to make, obviously, U.S. market is all dollars. It's a single currency that works pretty well. Europe obviously is a mixture of currencies, so there are some complexities for managers as they seek to have funds that might be denominated in euros, but have to make loans in different underlying currencies. The last thing I would say in terms of the makeup of the markets, again, U.S. Has fund-based lenders, but also these publicly listed BDCs that make loans, which I referred to a bit earlier, but also very, very little on the banking front. Europe doesn't have government-sanctioned advantages that helped propel the BDC industry in the U.S., so you really don't see many listed loan vehicles here. It's mostly fund-based lenders. But also remember, unlike in the U.S., banks probably have, it's reported maybe 50% market share in Europe, in markets such as the UK and Germany. So again, it's more likely that, for example, somebody like Ares would be facing off against another bank, whereas in the U.S., it's mostly funds.
I will make a short note because I saw some questions before I will ask my last question to Blair,
Sure.
and I will take your questions, is that direct lending, and correct me if I'm wrong, Blair, direct lending is providing debt financing to middle market companies that they are targets for acquisitions from private equity funds. That means when a private equity fund is buying a middle market company, will raise debt from a direct lender, and the direct lender will put the debt and the private equity will put the equity. That means they provide debt for LBOs, or they can provide debt directly to a corporate. But the majority of the transactions, they're LBOs, correct?
Yeah. Here's what I would say. Private equity firms are certainly some of the heaviest users of leveraged finance. And in particular as well, they tended to be the most early adopters. They're obviously very financially sophisticated as well, very early adopters of direct lending. So they would use a direct lender when they're buying a business. But again, they might have businesses in their portfolio that have loans that are 5 years old, they come to maturity, and they might face a situation where maybe there were banks financing the company for many, many years ago. But given the tightening regulations that I mentioned before, the bank might take the view that they want to dramatically reduce their exposure to this company, creating a gap or a hole that a direct lender could then in fact fill. Lastly, a private equity might own a business that wants to make a significant acquisition. And again, for a bank to react that quickly, process the information in the acquisition time frame is becoming more and more challenging. Hence, again, another reason why direct lenders can be useful.
And my last question before we take the questions, please, if you have any questions, please submit them now, and we will take all the questions in the next 5 minutes, and we will share it with Blair. Now, regarding the market, you have the banks, that they were the traditional providers of leverage finance. Now you have the banks, pulling out, direct lenders entering. But at the same time, we see funds of funds like Harbour West, Adam Street, Neuberger Bergman, that they're investing in private equity funds, and they have big LP positions to develop direct lending arms. That means, they have the relationship with the private equity funds, and they can provide debt too. Do you see the funds of funds coming in parallel with you and taking more stake in the market and more piece of the market?
Yeah, it's clearly a nice validation of the market. Again, as I articulated during my presentation, we think it's a highly attractive, market, and the fact that more participants want to come in is a nice sort of check the box in validation. However, I think what we bring to the asset class is, again, we are, as I mentioned, we've been in this space for decades, and in particular, when you look at the number of staff and originators that we bring to the table. Remember a slide I showed earlier, we have 190 people focused on direct lending investments in the US and Europe, and I think that that's what enables us to see so many opportunities every year and be highly selective in terms of what we're doing. So when newer entrants come into the market, they might not have as scaled origination capability. That being said, there are also potential conflicts of interest when players come in that have exposure to multiple parts of the capital structure through different vehicles as well that I think you need to be a bit careful of. But I think it's hard to see new players coming in and really developing that origination engine that players like Ares have developed over the past 20 plus years.
Okay, let me take the first question. Is from Giacomo. What would you say are the covenants that a direct lender or you would never give up, as opposed to broad syndication lenders, or they're looking at the big deals and they're mostly covenant-like?
Yeah, sure. So again, covenants for us remain incredibly important. One reason for that, by the way, if you pick up on something I mentioned during my presentation, we tend to be the only lender to our portfolio companies. Therefore, we need financial controls. Our loan is completely illiquid. If the loan had no real financial controls, we'd literally be writing a call option to the equity owners of the business. And that's not really what we're trying to do. So to answer the question specifically, if there's one financial test that you really want to have and focus on, that tends to be what we would call a leverage test, which takes the company's net debt balance and divides it by its profitability or EBITDA. What that protects against is if the company does meaningfully underperform in its performance and its profitability, it would ultimately trip that test, and we would be at the table because the company would be in violation of their loan documentation. I would say if you get a second covenant in a deal, it would tend to be some kind of cash flow test. Again, that starts with profitability, so it has some similarities to the first covenant I just mentioned. However, for businesses that are working capital consumptive, for businesses that are seasonal in nature, et cetera, you really want to make sure that, down the cash flow statement, you make sure you have enough cash. What we call a DSCR, a cash flow test, would be quite critical.
There are 4 or 5 questions in the same space from 5-6 participants. It's about, and I will try to summarize it in one if I can. Basically, at the moment, we're talking about private debt, direct lending for middle market companies, for private equity transactions, and that there is a specific pricing, specific debt characteristics, specific return. They are asking if the private credit can have application to infrastructure, agriculture, energy, and other areas, or it's a totally different type of direct lending.
Sure. Again, I think it'll depend on the manager. Every manager will have a slightly different focus and what they guide their investors to expect. I would say that historically, the infrastructure space has tended to be a little bit different given the contractual nature of revenues in that space. That tends to be a little bit different. Those companies tend to price, a little bit tighter than your average corporate loan. It might have slightly higher ability to leverage, but certainly from our perspective, we're able to look at any underlying company and industry as long as it fits the risk return that we think is appropriate, for the business and what we guided our investors to expect.
Another question from 2-3 participants is regarding if you can give a range about the debt quantum that you see in the transactions and the interest rates, but of course they vary between senior debt, unit trans, and subordinate. The range between when you lend in transactions.
Yep. So obviously, we'll put a lot of caveats on this. When we price a loan, it tends to be very, very bespoke to that company and to the business plan that they're trying to achieve. So again, this is not sort of one size fits all, type loans. There will also be certain determinations based on the geography, industry, et cetera. But I think, when you look at and remember, one of the slides I had put up before with some data from the U.S. over the past 10 years, the average middle market loan, priced, and again, that would have been on a senior / unitranche basis around, 7%. So I think, that's kind of rough market guidance as to what, one could expect in the future, although, recognize market situations do change and every credit is different. But hopefully that gives you a feeling.
And there's another question from Michael. Middle market direct lending is becoming larger and larger. You built a larger portfolio, you grow a lot. Will you build a syndication platform as banks continue to scale back, particularly in Europe, so that there is more concentration and less competition from underwriting banks? Or you will take down on your own what you underwrite? That means, will you go in the syndication model, or you will raise larger funds?
Yeah, it's a really interesting question. Here's how I would think about it. Again, we look a lot to the U.S. market because we sort of think that our market is heading in a similar direction. And in the U.S. market, there's a bit more of sort of a club syndication aspect. I think part of that historically is because the BDCs, which have held, a big chunk of these loans, have had very significant diversification requirements. But again, my perception is that the U.S. middle market loan space has more sort of club deals and participants than probably what we see in Europe today. Again, Europe's developed thus far into a bit more of a sole lender market on the fund side. However, as companies and deals get bigger and bigger over time, there is a potential that at some point participants might want to, have some element of syndication in their loans. And frankly, bridging on one of the questions you had asked a little bit earlier, that might be where it makes sense to sell down to a new participant who doesn't have the same origination capabilities, but again, sort of retain the economics and control of the loan within the main lead fund.
And probably the last question, where do you see what's the advantage and disadvantage of the direct lenders, especially compared with the capital markets, going to the bond market or going to the banks? And where do you see this market going? In which direction?
I'd love to just focus on a piece of the first part of the question a little bit. It's really interesting because over time, as we've been able to do slightly larger and larger loans to larger businesses, I would say there's a little bit more overlap between what we do in instances with the liquid markets. And when we're talking to companies, when you are a business and you're doing, for example, a high yield bond or a leveraged loan, what happens? Number one, your loans are quoted every day. If you're a company, you do not know who all your lenders are. First of all, there can be hundreds in a particular loan issue. Number one. Number two, it actually trades all the time. So, for example, when companies want a solid relationship with their lender, if they have a complex business plan, they want to make sure that the lender is supportive over time. That's when using a direct lender can really be attractive, for companies. In addition, as you may know, if you're dealing with an underwritten situation, the pricing of that loan can flex. That basically means is that the underwriting bank has some ability to change the price of the loan depending on how easy or hard it is for them to sell. A lot of companies, frankly, want to know what their cost of capital is. And again, going straight to a direct lender can enable that to happen. Plus, again, we can be quick, we can be confidential, et cetera. So again, I think companies are finding more and more advantages of partnering with direct lenders as opposed to going to the capital markets. And I think that's one reason, to the second part of your question, we see this market continuing to grow. What we do will always in some ways be a derivative of private equity and LBO activity, leverage finance and refinancing activity. But again, as our capital base grows, as we can address larger companies in different parts of the world, we think more broadly the asset class will continue to grow in the future.
Thank you very much, Blair. You will have the opportunity and the pleasure to attend Blair's session during the Oxford Chicago Valuation program that will take place 27th of April in Oxford. He will go in depth in all the structuring, valuation, financing, risk and returns issues around a case in the leisure sector in UK that is presenting for 3 hours. Let me describe the program. The program has started 2013 and is so successful, providing 3 types of offering. We provide the theory in the mornings in basic concepts that I will describe. We have cases from very senior professionals, and then we have some finance applying in Excel, modeling sessions that we can see how the concepts are changing in a group context. That means the first day we will have the foundations of valuation from the Deputy Dean of Chicago, Professor Douglas Skinner. Then we will continue with a leverage finance case in telco sector and a discussion around leverage finance from the global head of Goldman Sachs, Dennis Coleman, in leverage finance. Then the next day we will have James Hartog to talk about mergers and acquisitions theory, and he will cover 3 cases. Then we will continue in the afternoon with private debt and the case in leisure sector from Blair. In the afternoon, we will have an M&A modeling case after you understood the theory and we discuss the case. You apply the concepts in a group concept with Jeff around a modeling workshop in the food sector in US. In the afternoon, we will continue with a US corporate acquisition case in the healthcare sector from Dimitris Siroidis, Managing Director of Rothschild. And we will close with selected topics in valuation, how you can structure your private equity funds and your M&A transactions from a legal perspective, and how these legal issues, they affect your commercial issues with Chris Callos, partner of Kirkland & Ellis. We will continue Wednesday after we covered valuation, leverage finance, M&A. We will continue the third day with how and why capital structures affect valuation. Should I have senior debt? Should I have subordinate debt? Should I have debt? Should I have equity? How I will structure my equity? Should I have a shareholder loan, a convertible preferred? Then we will continue after we have understood debt and equity with LBO investment theory. We will continue with a modeling workshop, modeling an LBO, and then we will close with a case from Luis Duarte, that he was a director with Bridgepoint, looking at the retail sector in UK and talking about an LBO investment case. On Thursday, we'll continue with another asset class of private equity, growth capital investments. We will discuss the theory, and then we will have a modeling exercise discussing all the issues, doing growth capital that can apply to private equity or to venture capital, discussing all the issues that we have when you do minority investments, how you structure it. You structure with a priority, convertible or shareholder loan. Then do you have a dilution? Do you have a full ratchet, weighted average ratchet? Have you structured your liquidation preference, etc., etc.? Then in the afternoon, we will continue with another asset class, distress, and the global head of Evercore is flying from New York to do his theory part and a case in distress investments in the insurance sector. Rupesh Shah will cover in 5 hours theory and cases around distress. We will have a reception at Exeter College where we will have a very interesting discussion around family capital in direct investment with Tony Pritzker, that is the chairman and CEO of Pritzker Private Capital from Chicago, and Paul Carbone, the president and managing partner. One of the most well-known private equity funds based in Chicago, investing in middle market in the US. And then we will have next day covering the last 2 remaining asset classes. In the morning will be real estate investments theory and cases with Keith Breslauer, Chicago Booth alumnus and founder of Patron Capital based in London. And we will cover infrastructure investments and an infrastructure case with me and Matteo Botopoala, that is a managing director with Goldman Sachs Merchant Banking. And this will be a very intense program, 8 to 9 every day, covering theory, modeling, and cases in valuation, leverage finance, M&A, capital structure, LBO, growth capital, distress, real estate, infrastructure. Probably you will need 5-6 courses to cover all this, but we managed to cover everything in 1 week, and you have all the tools and the models. 1,400 pages, 2 books, theory and cases, plus a USB with all the models that you can use after you will finish this program. And keeping in touch with 2 great schools, University of Oxford and University of Chicago as alumnus. Now I will pass you to Steve that he will describe if you have any interest for this program. You can contact Steve and you can have a call with him about the program, and he can give you more information. And now I will pass you to give you more details about the week that is happening in the program.
All right, thank you, Andreas. Yeah, so next steps, the program runs once a year. We have quite a roster of guest speakers to gather, so we do that once a year. This year's iteration is coming up in a couple of months' time. It runs from Monday to Friday, 27th of April to the 1st of May. The registrations are open now. We take up to about 40 people in the class. We're halfway there. We expect to fill out a few weeks in advance. So if you are considering joining us, then we recommend that you apply over the next month or two. Don't leave it till the last minute, because we will have a waiting list as we did last year. So any questions, the full breakdown is on the website. You have the URL in front of you. You can contact me or have an email from me in a day or so's time with a recording of this webinar. And you can also contact my colleague Abdul Hibachi, whose details are on here. And we would love to follow up with you and go through any details or questions you may have about the program. As you'll have heard from Andreas, it's a very comprehensive program. We get in as much as we can in the 5 days. So it's intense, it's practical, and people who come love it. They just wish it was longer. So come and join us. With that, I want to close off for today. Thank you very much for joining us on this webinar. I've had a good interaction on there. Also want to thank Blair Jacobson from Aries Management for his time and efforts and expertise. He's sharing that today. And Andreas Angelopoulos.
Thank you very much.
Thank you.